Okay, good afternoon, ladies and gentlemen, and welcome to the next installment in the Admiral Markets Trading Spotlight webinar series. And here we are today to talk about how to trade the London FX Open. A fascinating and interesting subject, and like most things in trading, many ways to do it. Okay, the old English saying of many ways to skin a cat is equal here when it comes to talking about how to trade the London FX Open. But it is a very popular subject, and what we're going to do today is I'm going to give you my version of it. Okay, I'm going to give you a little bit of insight into how I view it and look at it, and what we should be able to do is to switch across to the charts at the end of the session to see how it's played out this morning. So make sure to stay with us, okay? And so we can all go and join the see the live market action together. As always, I appreciate that we have a broad range of experience here in the room, so from complete beginners to very experienced traders. So it'd be great to hear what your experience has been here. For those of you who are joining us here live today, if you could put in the chat box, what has been your experience of trading the London FX Open, and how do you do it? Do you like to trade breakouts? Do you like to trade false breakouts? Do you actually avoid it? Okay, are there particular patterns you look for? If there are, it'd be great. Just put it down. Equally, if you're watching this later on YouTube channel, then if you are enjoying it and get some great insight, well then please give us a like. Or if you've got particular questions or ideas for future sessions, then please pop them in the comments box. We're always happy to hear feedback from our viewers, and we're always happy to sort of engage with you and sort of try and make Trading Spotlight as accurate and as useful and as helpful to you as you can. So I appreciate when we're doing this. It's been a rather tumultuous year, hasn't it, ladies and gentlemen? Okay, and we're not really quite out of it yet so far. So, here for us all at Admiral Markets, we hope that you're all safe and well. We really appreciate you joining us for this session, and hopefully it'll help you progress in your own trading journey. So, what are we going to talk about today? Well, we're going to talk about what's so important about the London FX Open. Why is it of interest to traders? We'll talk about, what does a trader need to be aware of? Okay, what do you actually need to make sure that it's part of your routines and habits behavior before you actually think about engaging with the London FX Open? And as I said, I'll just give you a little bit of a hint, a little bit of insight into one of the ways you can do and utilize that for your own particular trading behavior. For those of you who don't know me, okay, my name's Paul. I've traded for many years now, okay, and coached hundreds and thousands down the years. Primarily, my own trading is FX indices and commodities, and for swing positions, swing and position trades, I tend to be a dominant trend trader. But when I'm trading intraday, I tend to be sort of mean reversion and reversal style trader, which kind of plays in a little bit to what we're going to talk about today. And here for Admiral Markets, as you can see, there are FX and CFD broker that provide a wide range of financial instruments that are licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular products and allowing you to engage with markets using both the MT4 and MT5. And if you have any questions about Admiral Markets, please get in touch with your account representative, and they'll be very happy to help and guide you. But today, we want to talk about trading the London FX Open. All right. So, as the slide says here, London remains the preeminent center for FX trading. The vast majority of FX flows occur during the London session. With this in mind, it makes the London FX Open a very popular time window for traders to engage with the markets. It can provide plenty of opportunity for a trader who is educated and prepared. In today's session, we'll take a look at the London FX Open and one way that you could actually trade around it. As I said, London is still very, very popular. Okay, it is still the kind of the main FX trading session, and also that kind of attracts crowds from not just from London, but Europe and in fact the world to actually see how the kind of London FX Open occurs. And with that in mind, okay, it's a case of effectively being able to understand, okay, and as it says there, be educated and prepared about what actually happens around the London FX Open, and also actually what you could actually do to effectively engage with it in a sensible and perhaps profitable manner for you. So before we dig into talking about London FX Open, I'm always very, very clear about ensuring that we're setting the right pre-market routine. Okay, and today we're going to talk about London FX Open, but actually, if you're going to intraday any kind of trade session, it is important to have the pre-market routine right. Okay, it doesn't have to be pages and pages. It can just be very, very simple. But what it does is it gets you into the right mindset, gets you into the right attitude, gets you right sort of focused on what really needs to be done to ensure that you do yourself the best favor, okay, in terms of being able to trade that well. So a price action trading plan should be simple and clear, especially when intraday trading the London FX Open. So, as part of that routine, I always suggest that you should identify significant levels, okay, in month, weekly, and daily charts. Looking for price action triggers at particular levels, which we are going to touch on a little bit later. When entering a trade, be sure to wait for a break of the candle. Okay, sometimes see a particular candle, they start seeing it form, and they get excited, and they want to get in on the trade before the actual candle has completed and formed. And in those last few, what might be minutes, moments, seconds, the actual sort of candle can change. Okay, as the trading goes on. Make sure that you always have a user stop loss, and it's always on the, invariably on the other side of the candle or other side of significant level. You never risk more than 1% of your capital on a trade, and you're always looking to target at least kind of 2-to-1 reward to risk or towards the next significant level. And one of the great things for good traders is to record your trades, review them, and repeat them. Okay, and as I said, I make no apologies about I always talk about this whenever we sort of start talking about intraday trading. I always kind of bring up these couple of slides because it's really key. It is absolutely really key, and I really want to get that message across to you that ensuring having the right pre-market routines, okay, the right kind of habits and behaviors will have a huge impact on your ability to sort of trade successfully. And part of that is all about having yourself some simple rules and expectations. This is about you demonstrating your trading discipline. Risk management is absolutely key. You always honor it. Okay, you always honor it. It's always about make sure that you live to fight another day. You make sure that you know what news is coming out for that session. It's not terribly difficult. Okay, on the Admiral Markets website, you'll find there is a economic calendar there, which will inform you of what pieces of data are coming out that particular day. You don't want to step in front of a freight train, ladies and gentlemen. You can help yourself not do that by making sure you know what kind of news is coming out for that session. If you're going to do some analysis, well, my suggestion is you do it before you actually sort of switch to your trading mindset. Make sure it's up, done, and ahead of you. Resist the temptation to trade out of session. Well, what does that mean? Okay, well, here today we're going to focus on the London FX Open. But what we say is, if you're trading the London FX Open, you'd probably want to focus on particular instruments that are suited for that London FX Open. So, for example, some traders might trade things like the euro against the sterling, okay, because what's happening, you've got the two main elements of that currency trade, the euro and the British pound sterling. Well, the vast majority of institutional traders are going to be trading that during the London FX Open. If you're trying to trade it at 11 o'clock in the evening UK time, well, you shouldn't be surprised if you struggle, because actually the vast majority of the big institutional traders, are not trading at 11 o'clock in the evening. They've finished their day at about 3, 4, 5-ish and have gone home. So just make sure, resist the temptation to trade the instrument out of session. Very simple. Ensure you have a good internet connection. But, I can talk about personal experience there of trying to intraday trade and losing internet connections. Okay. And it just happens to us all. All right. Even, when we use tech, it will fail at some point. So just make sure you've got a good internet connection and a possible backup. And make sure you're rested and prepared for any intraday trading session. Okay, if you've had a bit of a late night, you've not had a particularly good night's sleep, or maybe you spent the evening, arguing with your partner, these are not good things to sort of get up next morning and expect yourself to be, 100% able to perform to the very best of your abilities. Ensure you're rested and prepared for the session. Okay, it's in your interests, all right, to put yourself in the best place possible to be the best trader you can be when you sit down at your trading desk to engage with markets. So as I said, I always put these slides in when I talk about intraday trading. I make no apology for it, because these are all the things that good traders do until it becomes naturally part of the way they operate. Okay, it's just their natural way of operating. They wouldn't think of operating any other way, because they know its importance and how it helps them be the best they possibly can be. So when we look at the London FX Open, what I've got here is just a simple sort of Forex market time chart here. Let's bring up the old drawing tool here. As I said a couple of slides ago, London is still the kind of major FX center, right? Which means when we're looking at here, and if we just look here at kind of, GMT time from sort of 7 in the morning, okay, 8 o'clock here, Well, not unsurprisingly, what we're seeing is the kind of the London opening happening here about 8 a.m. London time, okay, which I appreciate might be different because we have a truly global audience, okay, here. So that might be like 3 o'clock in the morning, okay, if you're watching us from New York. It might be sort of 10 o'clock, okay, it might be 10 o'clock in the morning if you're watching us here towards, sort of Central and Eastern Europe, okay. So just make sure that, we're talking about 8 o'clock London time, London local time. Make sure that you are able to sort of identify where that is, depending upon where you are sat in the world. It's not terribly difficult. But what we can see is that, not unsurprisingly, during that European session, you have, there's a lot of focus on trading the pound, the euro, and the Swiss franc. Okay, and to a lesser extent, the yen and the Aussie, and then really, whilst there will be trading against the dollar, because just basically the US dollar is the great big gorilla of the FX market. The vast majority of that is going to be happening later on in the, let's say, in the European session, when the American session opens early European open time, which happens around about now. Okay, around about now, sort of about into that time. So it's just important to recognize that, as I said, London, okay, London, the FX London Open is still the kind of major open when it comes to the FX market. Still a huge amount of flow and energy comes towards that market. And as I say, even from people all over the world, I know of traders in America who will, get up and at 2 o'clock in the morning, 3 o'clock in the morning, and will be trading that. Equally, I know traders in Australia, okay, who'll be trading at the end of their day, but they'll be sat there in their evenings, okay, trading, because it's the same time here as in London. It basically attracts a great deal of traders, and with that, well, then, not unsurprisingly, when you get that focus and interest, well, then, you also get elements to do with, volatility and liquidity as well. But what you want to do is to make sure that you're aware of it. And we're going to touch on that more in the next couple of slides. So before we start looking at it, let's think about who are actually going to be the major FX market players, okay, that are going to be coming to that particular market, all right, at that time. They're going to be coming to that particular market session. Well, generally, we have sort of kind of four major types of market participants, all right, of the major types, okay. So we'll hear the market makers, okay. In the old days, these would be called dealers, but every day these days we tend to call them market makers. You then have your corporate accounts, okay. What does that mean? Well, that's the likes of, Ford, okay, that's the likes of big international companies, okay. And you have to remember this, the vast majority of the FX market is there just to facilitate international trade. It's actually, the next part, speculators, of which we would be deemed to be one, a minor part of speculators as a private player, as opposed to hedge funds, etc. We're speculators, and then the big daddy of them all, the kind of the central banks. Okay, the vast majority of the major central banks in the world will basically be a participant in the FX markets, and all of those, okay, all of those will be involved in the London FX Open to one extent or another, based upon what's going on at that particular time of the day. And so it's important to recognize that. Okay, I appreciate sometimes new traders think that it's just them, that they're just trading with and against other speculators, but there are huge amounts of players in those FX markets, and you have to remember that the main focus of most of these is actually just trading dollars or trading currencies, because they are just effectively facilitating international trade. And you shouldn't ever forget that. But what we can do is, what we can help us is start to maybe think maybe less like a sort of private speculator, and more like, well, how do the dealers, how do the market makers actually look at them? How do they start to understand the markets? So what we have here is a kind of like a dealer's motto, a market maker's motto, because they understand that market moves are rarely one way. Okay. Dealers understand that the majority of the time, intraday markets are range bound, around about 80% of the time. Now, just think about that. It's normally about 4 days out of 5. Invariably, it never works as clear cut as that, because you have periods during the year when invariably markets will trend, and there will be periods during the year where markets will particularly be range bound anyway. But as a rule of thumb, okay, as a rule of thumb, they understand that the majority of time, intraday markets are range bound. What they also realize is that they realize never to trust the first price. What does that mean? Well, after a news release, okay, remember we talked about that, you need to make sure of these news releases, you need to look on the economic calendar. Dealers know that the first price print is the knee-jerk reaction of the market, and very often it's wrong. Not always. Sometimes it will take off and go just because of the nature of the way that news has come out. But more often than not, they know that the first price print is the knee-jerk reaction of the market, and it can often be wrong. So this is their kind of what they understand and know, and it would help you as a private trader sat at home, okay, to recognize and understand this is how one of the other major participants see those markets, okay, and it's if you can understand how they're seeing the market, well, then that might also help you in the way you look at the market and the way you understand and the way you identify possible opportunities for yourself. But that dealer's motto can also be kind of broken down into the fact that what we learn about dealers and market makers is that they are always fading a move. All right. So if you want to think like a dealer, well, then you need to think in terms of ABF. Always be fading. All right. Always be fading. Always be taking the other side. Now, that's all very nice. It's very easy for me to say, but actually, you might be sat there saying, well, no, that's great, Paul. Yeah. But actually, what does that mean? How does that actually help me in trading? And I just say, have some patience, my young Padawans. Just wait on and we will move in a few slides and we'll start to see how we can turn that into a particular, what it looks like in a chart and how you turn that into a bit of a trade plan that you can utilize in your own particular trading. So what can we learn and understand from those market makers and dealers, how they're operating? Well, one of the things it's useful for you to understand and know is that dealers only make money when orders are triggered. Think about that, okay? Dealers, those market makers, they are filling orders, okay? Now, of course, in the old days, it would be, chaps on the phone talking about it, shouting and screaming. These days, of course, it's all, with price matching engines, okay? Vast majority, if it's all done, through algos and over computers, there's still an element of human interaction in that, but the same thing, okay? They're still matching orders, all right? And what happens, think about this, okay, is dealers and market makers, they only make money when orders are triggered. Think about that. So if you think about that, they're always going to say, well, they're always going to want price to go towards where the biggest pools of orders are, because that's how they make money. So it's not all surprising is that they might bully price towards where the biggest numbers of orders are. Just think about that. Take a moment to just consider that and take that on board if you weren't aware of that. All right. So, we have in previous sessions here on the Trading Spotlight, we have covered quite a bit about where those orders are set. You can find them in the Trading Spotlight webinar archives if you go through them. But what we can also talk on is thinking like a dealer means that we change our way of operating. Okay. So majority of the time when we're here, we're talking about being a longer term trader, maybe a swing trader, position trader. When we're a longer term, a swing trader, well, then we tend to be trend followers. We tend to find those kind of long particular trends that we can get on board. But as I said myself, when it comes to intraday trading, very much shorter time frame, I tend to lean and focus towards being mean reversion and reversal trades. Because remember what we said a few slides about, about dealers. Dealers know that the vast majority of the time, the intraday markets are range bound. And they also know that actually, when a price pumps on a piece of news, it very often can be a knee-jerk reaction and price can actually slide back to where it came from. So, that's why when I'm intraday trading, I tend to focus more on mean reversion and reversal trades. So let's start to have a little thing and let's start to sort of put that into what we can see on a daily basis. So think about this, it's sort of kind of, just before 7 o'clock in Frankfurt time, okay, it'll be just before 8 o'clock in London time, all right. What we find is, those European traders, the institutional traders, they're making it to their desks. And what they will take a look at is the overnight action in the Asian session, all right. Think about this. They're going to look at that. Now, when I first started trading many years ago, the Asian session was actually very, very small, very, very thin. Okay, very little happened. It was not unusual, okay, for them, FX markets to go into maybe a little tight 30 pip range, okay, overnight because very little happened. Definitely over the last 10, 15 years, okay, that has changed, okay, as we've seen China kind of become more bullish on operating in its financial markets. We've also seen, greater scope from, trading centers in Singapore, okay, Hong Kong, Tokyo, okay, Sydney, even Wellington, that has had an impact. And so actually Asian sessions can be quite volatile sometimes, not all the time, but sometimes they can be, okay. But what you want to do is to have a look at, what was the Asian session like? Okay, what was the kind of action overnight in that Asian session? Remember, FX pairs are trading on a 24-hour, 5-day basis. And what it does is it helps us to identify the major part of the Asian session to get an idea of the range. I want to understand, was it a busy period, okay? Or was it a quiet Asian session? Did it go into a very small, thin period of consolidation? What was the kind of range that we traded in? And this is one of the first things we look for because it forms a basis of what we're looking for in our trading method. So what I have here, we'll see it more. We're going to switch across to the charts. So actually, hopefully you can see on my chart, there is a kind of a dark gray block there, which I have on my screens. And that basically what it does is it just effectively draws a block around the overnight Asian session. All right. So I'm looking at that from effectively London time. Okay. London time from kind of midnight till 7. Some people might change it a little bit, but as a general rule of thumb, that's what I'm looking at. Okay. And that's what, I have a little plug in there, okay, that draws that for me. It's a very simple plugin. You can find that across, all the kind of MT4 and MT5 resource packages. And what that does is that helps me identify what was the Asian session like. So in this particular example, we can see that actually, for most of that Asian session, it was actually quite quiet until we actually finished with a bit of a thrust to the downside, right? And so that actual Asian range expanded. And this is what I just want to be able to draw my mind to and to look at and to see, okay, what has gone on? What was that Asian session like? And I'm going to explain more now as we go through over the next couple of slides. So why is that of interest, or why is that of relevance? Well, despite the fact that we have huge amounts of algo trading going on within within all markets, we still have the fact that markets are still traded by humans. Okay, even the algos have been programmed by humans. Okay, and they reflect their personality characteristics, biases, and their own particular learned experiences from markets. But what we see is that humans still look at charts for usual places to do their business, all right, for simple places to do their business. So that can be elements like big round numbers, okay, big psychological numbers. So for pound against US dollar, up until recently, what we've seen is lots of trading around 130, okay, big round numbers. We also see traders doing trading around previous highs and lows. And those previous highs and lows are very tradable opportunities. This is especially true on an intraday basis. So those previous highs and lows, they might be the previous highs and lows of the last month. They might be the previous highs and lows of the last year. They could be the previous highs and lows of the last week. It could be the previous highs and lows of the last day, but also they might be looking at the highs and lows of that Asian session. Okay, the highs and lows of the Asian session itself. Here we have it there. Okay, just understanding that. They are still usual places that humans will look to trade where they will do their business on an intraday basis. And that is something that we can find, we can identify, and we can start to hone in how we might want to operate when we see that. So previous highs and lows are tradable because there are usually lots of stop there, all right? There's usually lots of stops. So what you might find is that the traders might have orders, stops and limits orders in to actually either for their stop losses to take them out of particular trades they've taken, or to take in new trades, okay, as price breaks out of those Asian ranges. But remember what I said a few slides ago, right? If there's usually lots of stops there, then they become attractive for dealers. They become attractive for the market makers because remember, there's lots of orders there that when orders are triggered, that's when market makers get paid. What they do then is they offer us points for a mean reversal trade, okay? It's an ideal setup for a reversal trade. So let's have a look at a few ideas. So when we can see here on this particular chart, you can see, we're drawing in our Asian session here. Price had already come down and price broke out, okay, of the previous lows of the Asian session there. And you can see for yourself what the price action was happening there, okay, once it had broken out. And we're going to look at that in a little bit more depth in a few slides' time. At the moment, I just want you to recognize that, previous highs and lows are very interesting to us, and that effectively the Asian session is very interesting to us. And also just to recognize that, you remember, market makers get paid where orders get triggered. So they are always going to be interested in areas on the chart where lots of orders are sat there for them to make their money. Opera asked me a question about, is this chart on 4 hours or 1 hours? This is just a particular chart there, so that's probably a kind of a 1 hour chart there, but we'll look at that when we move across to looking at the live charts, Opera. But thank you for clarifying that. It is, yeah, that will be a 1 hour chart. That's just for the purpose of illustration. We'll look at it in a bit more depth as we go on to the next couple of slides. So this is an example for the euro dollar against on the euro against the dollar on the 15-minute chart, and hopefully maybe what you can see is I've just drawn in a kind of few levels where we can see how price reacts to kind of previous highs and lows. Okay, here we had we priced at the previous high, it broke out of it, and then it actually became the support before it moved on. And then the following day, okay, we came down and we hit the kind of previous low of the previous day. Price just pushed through it, okay, but then it reversed and fell away, and then we put up to a new high here. Then the following day, the first time it touched the previous high of the yesterday, it kind of dropped away, touched it again before it blew through, okay. Just move this around. And if you look at any particular charts, what you'll see is that there's just this repeats time and time again across lots of charts, and one of your tasks, which we'll focus on in a few slides, is literally, just pull up some 15-minute charts, okay, 5, 15, 30-minute charts, okay, of your particular favorite currencies, and just go through just drawing this on, okay, just drawing on where the previous high was, okay, where the previous low was, and watching how price react to that to the very next day. And you might be fascinated to see that, very often, okay, more often than not, there will be a reaction to that, and that reaction can very often provide us with a tradable opportunity that we can utilize around the London FX Open. So how do we use this info? How do we turn this into trade? So every day as an intra-FX trader, we want to know what, if any major news is being released. Remember, that's very important. We don't want to step in front of that. That might actually help us because it's actually how price reacts to that news that might give us a setup for an opportunity. We want to identify the previous day's highs and lows. Also, the weekly highs and lows are as good as well. And we also just want to understand the highs and lows of the Asian session. We also want to be aware of any significant big round numbers, okay? There's big psychological levels that we see on charts. When price reaches those areas, well, then you can look for a mean reversion setup, something like a pin bar rejection candle, an engulfing candle, a key reversal, or something like a double top or bottom. Today, what we're going to focus on are double top and bottoms, but we will do another one of these, okay, in a month or two's time, where we'll look at the other particular setups. But today, we're just going to focus on double tops and bottoms, just so that you can have something that you can take away and look at from charts from tomorrow, ladies and gentlemen. So listen, a double top and bottom is, not unsurprisingly exactly as the name implies. As always, I say, ladies and gentlemen, I'm a better trader than I'm an artist. So, please forgive me for my squiggles on the screens. It's as I said, I'm a better trader than I am an artist. But hopefully you get the idea. Okay, you know what's going on here. Okay, you've got an M shape. Okay, at the top, a double top, and a W shape, double bottom. Okay, at the bottom of a run, and if you can identify these at particular areas, that provides us with opportunities. Why does that work? Why are they of interest to us? Why does this trade sort of be useful? Well, what I want you to do is I want you to think about it like a rugby scrum. Now, I appreciate that there'll be parts of the world watching this that may not, play the game of rugby. But if you do, and if you're aware of it, you see the two packs hitting each other. And I want you to think of that like, it's like kind of looking down on a rugby scrum when a double bottom or double top is formed. Because what I see is price is like the rugby ball that is effectively thrown into the rugby scrum, and the two packs, the rugby scrum, you've got the Bulls and the Bears, as they try to wrestle control from the opposition. They're trying to basically give each other a bit of the heave and grab control of the ball. At some point, one time, the team is likely to tire and fall over, and the ball, or in this case, price, is likely to get pinged out. In the markets, because price has already put in a move, an overextended move, okay, to perhaps a previous day's high or low, or to top or bottom of the Asian session, well, then we can anticipate where the price is most likely to shoot out in the direction of a reversal. And it's easy for me to show you that on a chart, but I just want you to think about the underlying dynamics of what is occurring. So what we can think about, and hopefully you can read this. I won't go through all of that particularly, but hopefully you can have a little read of it. If you're watching this later on demand, you can pause and read that. But, it's about understanding what has actually happened, okay? Traders are induced into long positions in this region, okay? Then effectively, there was always somebody taking profit. Some traders then decide that they need to go short, okay, in this particular region. Then price actually rallies up one more time. So those people who took the short, they get stopped out here, okay? Others might be thinking that they're going to join and get long, and then invariably those people who took longs are getting stopped out when price reverses there. What it means is, remember, there's lots of orders being triggered there. There's a big fight going on between the bulls and the bears. Okay, it's those rugby pack. Okay, the sort of the props. Okay, sort of just butting heads against each other, right? And we're working out who is going to be the winner, which one is likely to be the winner. But as I said, because when it comes to price, because we've already seen an extended move beforehand, well, then we have a bit of an idea that the probabilities are that actually price will come out the other way when we see this pattern happen at particular areas and levels. And that can actually be enormously useful, enormously helpful for us as a trader. And if you need a reminder, of double tops and bottoms, then open your left palm, ladies and gentlemen. If you see it, open your left palm, and if you just crease it a little bit, you'll actually see you've got a double top pattern there, on your left palm. So if you're struggling to identify one or struggling to see it, just take a look at your left palm now. Okay, I'm sure you're all doing it now. You're just opening it out, and you can hopefully see that there is a double top pattern there. Okay, just to remind you what you're looking for. Okay, when price has been moving up. So, what happens is what we're looking for the importance of confluence. Okay, and what we're looking to identify is we're looking to, as we said earlier on, looking to identify those kind of highs and lows of the Asian session, previous days highs and lows, previous weeks highs and lows, might even be previous months or previous years highs and lows, and also those kind of big round numbers, those big psychological levels. Because once price actually gets there, and we start to see this kind of reversal pattern, whether it be a double top or a double bottom, an M or a W, well, then invariably that gives us an opportunity to effectively take a mean reversal trade, a reversion trade, back into the middle. You can also use the ATR, but what we'll do is we'll cover that in a future session. If you don't know what the ATR is, I think one of my colleagues, Jens, did a session on the ATR indicator generally. You'll find that in the webinar archive that you can utilize. So this is an example. This is a little bit out of our time, but I just wanted to use it because it was a very simple, clear tip that we actually had here. This is the Kiwi dollar on the 5-minute chart. We had an M pattern there happened. That what is of interest and relevance to us is that it happened here at the previous week's high, and it was also yesterday's high. All right, so we had a confluence of events. Okay, price had pushed up. Price had pushed up, to the previous week's high, the yesterday's high, and then provided as a double top pattern, before price actually ran all the way down. And that was your nice intra trade. That's what we're just looking for. Just to use that one because it's just a simple example. That's quite clear, and hopefully you're able to see that. And as always, you just have to practice a little bit of looking on charts. Here's more of an example, in terms of around the London FX Open. So remember what I was saying, this block here is the Asian session. So it draws in, where the highs were and where the lows were. Okay, so when I'm coming here at the London FX Open, we can see, hopefully, you can see that price breaks out of the Asian session and then it hits this 130 level. Okay, big round number. And what does it do? It puts in a double bottom there before it shoots off all the way to the other side of the Asian range. Hopefully you can see that. We're breaking out of the Asian session at the start of the London Open. It hits the big round number, puts in a double bottom pattern before your trade is all the way nicely back up to this 200 period moving average. Okay, that's what we're looking for around the London FX Open. In this particular one here, this is once again the pound against dollar on the 15 minutes. This is the Asian range that's been occurring here. And what you can see is as we start to go into the London Open, we can see that price, what does it do? It puts in a double top pattern, an M pattern, before it drops. And where does it drop to? Well, once again, it drops to the 130 level. And so there's a trade there at the London FX Open from the double top pattern all the way down to the 130. Now, in this particular case, it actually goes much further, but you weren't to know that. Okay, you wouldn't be knowing that when you're looking to short that double top pattern. You wouldn't particularly know that at that time. But hopefully you can see there the Asian session there, price hits the top of it, double pattern, confluence of events before it drops away. And here's a kind of an interesting one in the sense that this is once again, this is the pound against the dollar and the 15-minute chart. And actually what we can see is, we're already here around the 130 level here. And you can hopefully see that, price is actually just respecting the level. So, we had the high of the Asian session here. We had the low of the Asian session. And for the London FX Open, what actually hopefully you can see is that price respected that Asian session for the whole of the London FX Open. That might well happen. Remember, we are looking to see how price responds when it gets to those kind of particular previous days highs levels, Asian session highs and level. And it's actually not until much later in the day that it actually breaks out and moves its way down. And where does it move to? Well, actually, it moves all the way down to the previous week's low, which is what this blue line is here. At that blue line will be the previous day's low. Okay, and you can see that price, it's in that range, but then it breaks out and actually moves towards that range. Okay, and it's a case of just once you start to identify, as I said, those previous days highs and lows, the big round numbers, the Asian session ranges. Okay, you can see that price, how it reacts there, because when it does, that starts to give you ideas about how you can actually trade. What you're actually particularly looking for. And here was a session. I think this was from just the week before last year. And just in terms of, once again, we've got the gray box is the kind of overnight Asian session. And then as we come into the start of the London session, what we get is a false breakout. A false breakout that forms part of a W pattern. And you can see price rallies its way up. Where does it stop first? Well, hits the Asian session, comes back before it continues on. And then later on in the day, what it does is it puts in another M pattern before it drops away. So hopefully, you can see that you can get a little bit of a false breakout there as part of a little W pattern before price goes to the other side of the Asian range and then actually continues onwards. And this is what's here. This is just a 15-minute chart, and all of this is happening around the start of the London FX Open, and just basically, as a trader, you have to basically know the patterns that you're looking for and sit and wait and just be a little bit patient. This is, in terms of the big round number here. So this is once again pound against dollar on the 15-minute chart. You've got the big gray range there. Okay. And what we can see is price actually breaks out of the Asian session and appears to be break away from the 120 level. But actually what it does is it puts in a really kind of big scruffy W pattern at the bottom of the Asian session at the 120 level before price continues all the way up for the rest of the day. So, I mean, that is a little bit scruffy, but the reason I show you that is because it's not perfect. Whenever you see trading, I can show you perfect examples, but actually sometimes you have to see scruffy examples like this to recognize how it plays out. The markets aren't always as picture perfect as we would love to see them. And you have to be able to recognize and trade what you see in front of you. And here's an example on the kind of pound against the Swiss franc here. And this is the 5-minute chart. And hopefully you can see there that, that's the kind of Asian session. That the green block is for the American session, okay, in the afternoon. And hopefully what you can see is that price breaks out of the Asian session, then forms a double bottom, double bottom there, W pattern before it rallies all the way up. And what stops the rally there, well, is the previous day's high from yesterday, before it puts in a very scruffy M pattern and drops its way through the American session, all the way down to the 120 area, and actually in this case below. So hopefully you can just see there, looking at how, even in this particular case, you can see here at the very start of the London session, price pops up, hits the top of the Asian range before falling down, breaking out of it, putting in a W pattern before it rallies up. And that was your trade all the way up to that before it actually hits an M pattern at the previous day's high before it drops all the way down to the big round number here and beyond. So, it might take a little bit of time, a little bit of practice, but as I said, watching this, looking at this, seeing how this develops can help you enormously. And, in this case, the big round number. Now, this is an hourly chart, but I just wanted to use it to show how it we can move. Here we have, this is pound against Canadian dollar. 160 is the big round number. We're actually, the Asian session here, okay, is the gray box, which we can see. Price actually pops out of it, but in this particular case, it puts in you can see there, a bullish pin bar, okay, rejection candle before price rallies its way up, okay, and that's what we're looking at. You've got the confluence event breaking out of the Asian session at the 160 big round number during the kind of London FX Open. That nice confluence of events gives us opportunity. So your task from today's session, ladies and gentlemen, is go away and open any chart on any intraday time scale, 5, 15, 30 minutes. Draw forward the previous day's highs and lows. Draw on any significant big round numbers. Draw on the Asian session and just look at what happens at the London Open to the Asian range. Okay, does the price get touched? Does the price actually get broken? Does the price do a false breakout? Look at what happens when price reaches those previous highs and lows. Does price power on through, or does it reverse and revert back into the range? And if it reverses, were there any significant price action signals like a double top or a double bottom to alert you to a possible trade opportunity? So in conclusion, London is still the major FX center of the world. Lots of people like to trade the London FX Open. And what you should do is start with understanding the size and the scope of the overnight Asian range. Be aware of impending news announcements. You don't want to be on the wrong side of that. But remember, 80% of the time, intraday FX markets are practically range bound. So learn how to trade reversal and mean reversion setups. Watch how price reacts at previous days' highs and lows and previous weeks' highs and lows and big round numbers. And being able to identify double top or bottoms, M or W formations is very useful here. So we've got a couple of minutes left. So why don't we have a little look at live markets and what we've had today to work with. So don't forget to join us next time. So at next time, what you'll see is on our next session, my colleague Marcus is going to talk about how to learn to use day trading strategies, including the basics of trading, components every strategy needs, and 5-day trading strategies. That is on 2 o'clock London time, Wednesday, November 18th. You can check your inbox for the webinar link or go over to the website to click to join the Trading Spotlight webinar series. There's plenty of analysis and education and resources on the admiralmarkets.com website. If you want to contact us, you can do on email, hello@admiralmarkets.com, youtube.com/admiralmarkets, where the recording of this will be, and facebook.com/admiralmarketsglobal. So I hope you found that useful, ladies and gentlemen. I mean, I could talk all week about trading the London FX Open, but we only have a short time window. But I hope that just gives you a little bit of insight into how you can look at the London FX Open and just get a little bit of a hint and of an idea of how you could utilize it for yourself. So if you'll bear with me, we've just got a moment or two, and I'll just have a quick look at the live markets, and we can talk about what we've seen there. So just bear with me a moment. Okay, so I'm hoping that you can see me here, and you can see this is the Admiral Markets demo platform. And if I just look here at the 15-minute chart, okay, the 15-minute chart of the pound against the US dollar for today, what we can see here is, I've just drawn on here is my particular grey box there, okay, and what we can see is, what happens here. Price pops out, which was also, if we just zoom out as well a little bit here, just getting boom. So what we're looking at here, let me just clear these down here. We're just looking at how we've got the Asian session there, how price just popped its head out of it, and then it went down to the other side of the Asian range. And if I just look at that quickly on maybe the 5-minute chart, just bring that up, clear those. What you can start to see is, here we go, price popped its head out there, put in a pin bar rejection candle before it dropped all the way down to the other side, okay, of the Asian range. Where at the other side of the Asian range, let's just zoom it up. What we saw was this puts in a double bottom here at the bottom of the Asian range before price rallies its way up. And for some of it, that would be your trade, the double bottom, trading it way back in towards back into the mean reversion, okay, back into the middle of the chart there. And hopefully you can see that, just making sure you're aware of those particular highs and lows of the Asian session and how price reacts there, that can start to be very, very useful for you as a trade view around the start of the US, around the start of the London FX Open. If we look at have a quick look just for the last moment, pound against the Swiss franc. This is the 5-minute chart here from this morning. Okay, what do I see here? Well, what I see here is you can see the Asian ranges there. Price. Well, actually, price puts in an M pattern there, but I don't particularly like M patterns in the middle of the Asian range. I like to see the edges. But price drops its way down. Where does it drop down to? 120. So it breaks the Asian range, and then it gets down to there, puts in a double bottom pattern before it rallies up. Where stops the rally? Well, the previous Asian, the high of the Asian session there. So hopefully you can just get a glimpse of what looking at, okay, recognizing big round numbers, previous days highs and lows of the Asian session, looking at double top patterns or rejection candles and how once price breaks out, you can trade it on the way back in. Now, unfortunately, we've run out of time. As always, I'd like to have done more, but as I said, we're always a little bit constrained by time. But I hope that you found that useful. I hope that's given you a bit of food for thought. If you've been watching this on YouTube and you like it, give us a like. If you've got questions, stick them in there. We'll very happily take them on board. And as always, I wish you the best of success with your own trading, ladies and gentlemen. And I look forward to speaking to you next Monday. Trade well, and I'll speak to you soon. Take care.